There's a sequence in financial history that fires with brutal consistency. Not every cycle, not by chance, but when the same ingredients converge. Extreme valuations, towering debt, leverage speculation, the illusion that exceptions exist. Then a single shock forces liquidation. Those ingredients were fully present in 1929. They existed in 2008. And in 2025, every one of those conditions is back. Not similar, identical. The setup is complete. The pieces are in place. And if history is reliable, the break hits in late 2026 or early 2027. This isn't prediction. This isn't panic. This is pattern recognition. Let me show you how crashes truly unfold, who gets wiped out, who profits, and why the 2026 collapse could exceed 1929 and 2008 combined. The scale is bigger, the leverage is heavier, the wiring is tighter, and the people in charge spent their ammunition fighting the last crisis, leaving nothing for the next. What follows is a documentary analysis of a crash that hasn't happened yet but mirrors a pattern that already played out twice with brutal precision. The mechanics are identical, the timeline is familiar, and the outcomes, who loses and who wins, follow the same script every time. Let's start with the present. January 2025, the setup. Every crash begins with a bubble. And we're inside the largest everything bubble ever recorded, not just stocks. Real estate in major cities is at record peaks. The median home price stands more than 5 times median income, far above historical sustainability. In 2006, at the top of the housing bubble, the ratio was lower than it is now. Corporate leverage is worse. Non-financial corporate debt is over $13 trillion, more than 70% of GDP, far higher than before the last crisis. Government debt is $36 trillion, 120% of GDP. Interest alone is approaching $1 trillion a year. Consumer debt, credit cards, auto loans, student loans exceeds $17 trillion. Total U.S. debt across government, corporations, households, and finance is above $90 trillion. That's more than 320% of GDP. Every major sector is stretched beyond historical limits at the same time. This is the everything bubble. Everything is overpriced, everyone is overleveraged, and everyone believes the rise will continue. Why? Because for 15 years, the Federal Reserve made sure of it. Whenever markets stumbled, the Fed cut rates or printed money. Every dip was rescued. Every correction reversed until now. Quantitative easing, multiple rounds of stimulus, trillions created between 2008 and 2022. That flood of money pushed asset prices higher and taught investors one rule: buy the dip. The Fed will rescue you. This conditioning erased fear. Risk stopped mattering because intervention became guaranteed. But there is a problem. The Fed spent its ammunition. Rates sat at zero for a decade. They cannot go lower. The balance sheet exploded from $800 billion in 2008 to $9 trillion in 2022. Any further expansion risks inflation, exactly what erupted in 2021-2022. To stop it, the Fed raised rates from 0% to 5.5% in 18 months, the fastest tightening in 40 years. Inflation slowed, but the side effects are severe. Debt issued at 3% must be refinanced at 7%. Mortgages that once cost 3% now cost 7%. The burden is crushing, and the Fed cannot cut rates significantly without reigniting inflation. It is trapped. Rates too low, inflation returns. Rates too high, debt becomes unpayable. There is no safe setting. This is the setup: maximum valuations, maximum leverage, and a Federal Reserve out of tools before the crisis even begins. Now compare this to 1929 and 2008. The patterns match. In 1929, markets surged 400% in 5 years. Margin debt hit 10% of GDP. Everyone was leveraged. Everyone convinced prices could only rise. Then October came. The market fell 89% over 3 years. In 2008, housing doubled in 6 years. Mortgage debt reached 100% of GDP. Borrowers used subprime loans. Everyone believed national home prices never fall. Then defaults spread. The financial system collapsed. The S&P dropped 57%. In both crises, the setup was identical. A massive asset bubble, extreme leverage, universal belief in permanence, and then a single shock that forced liquidation. The next crash will follow the same blueprint. We have the bubble. We have the leverage. We have the blind confidence that Fed intervention makes declines impossible. All that's missing is the trigger, and several are already forming. Here are the 3 most likely. Trigger 1. Commercial real estate collapse. This is the most probable because it has already begun. Office vacancies in major cities sit near 40–50%. Remote work cut demand permanently. Buildings financed at 3% must now refinance at 7-8%. A property that barely covered debt at 3% collapses at higher rates. Owners walk away because the numbers don't work. In 2023, Brookfield defaulted on 2 major Los Angeles towers, simply handed them back. Not because the firm was failing, but because those buildings were worth less than the loans. Rational default. Between 2025 and 2027, over $2 trillion in commercial mortgages mature. If even 30% default, losses hit $600 billion. And who holds this debt? Regional banks. Many have 20-40% of their loan books tied to commercial real estate. When these loans default, losses erase capital. When capital falls under regulatory minimums, regulators shut the bank. We've already seen the early wave, Silicon Valley Bank, Signature Bank. These collapses were blamed on rate risk, but the deeper issue is commercial real estate. If defaults accelerate through 2025 and 2026, 50 to 100 regional banks could fail, and bank failures always trigger panic. Trigger 2. Major corporate or sovereign default. During 2020 and 2021, hundreds of corporations issued cheap debt. That debt is maturing now. They must now refinance at rates 2 or 3 times higher than before. Many can't. If a major corporation, a household Fortune 500 name, defaults on its bonds, contagion erupts instantly. Bondholders panic. They dump other corporate bonds, yields spike, borrowing shuts down, companies needing to refinance get locked out, more defaults follow. This is the same mechanism that spread the 2008 crisis. Lehman collapsed, and the assumption became that everyone else might be next. Credit froze. The same chain reaction can ignite in corporate debt today. Sovereign default works the same way, but on a larger scale. If a major emerging market, Turkey, Argentina, Pakistan, fails to pay its dollar debt, investors question the rest. Capital flees, currencies plunge, more defaults cascade, and the losses don't stay contained. Western banks hold that debt. A wave of sovereign failures can jump from emerging markets to Europe and the United States. One default is enough to start the chain. Trigger 3. A geopolitical shock. War, a pandemic, a terror event, an election crisis. Anything that spikes uncertainty and forces investors to dump assets for cash. That's what happened in March 2020. COVID wasn't an economic crisis. It became one because uncertainty forced liquidation. When the future is unclear, investors sell everything. A similar shock, conflict with China over Taiwan, a Middle East war disrupting oil, a contested U.S. election, could trigger the same flight to safety. Any of these 3 triggers could start the cascade, but the trigger isn't the cause. The underlying problem is the leverage. Once liquidation begins, the mechanics take control, and those mechanics are ruthless. Here's how the crash unfolds. Phase 1. The initial shock. The trigger hits. Markets drop 10-15% within days. Investors are surprised but not terrified. They see a dip worth buying. Analysts insist fundamentals are solid. Commentators say the pullback is temporary. In 1929, this moment was October 24th, Black Thursday. The market fell 11% in one session. Bankers stepped in, promised support, and prices briefly stabilized. Everyone believes the worst is over. In 2008, the first shock came when Bear Stearns collapsed. Markets fell 15%. The Fed engineered a rescue. JP Morgan absorbed the bank, and analysts declared the crisis contained. The same illusion will appear in 2026. A major bank failure or corporate default hits, markets drop 10-15%, and the Fed issues the usual script. The system is sound, liquidity is available, investors buy the dip, prices rebound slightly, but the fracture in confidence is already there. Phase 2 is the false recovery. After the first shock, markets stabilize. Sometimes they even rise. This can last weeks or months. It's dangerous because it convinces people the danger has passed. In 1929, after Black Thursday, stocks recovered for days. By early November, prices were nearly back to pre-crash levels. Then November 11th hit, down 13% in one session. In 2008, after the Bear Stearns bailout, markets drifted sideways for months. By July, the S&P was only 10% below its peak. Then September arrived. Lehman failed. The market dropped 40% in 6 weeks. In 2026, the false recovery may run 3 to 6 months. The initial failures will be blamed on isolated mismanagement. The Fed trims rates slightly, markets bounce, investors decide the worst is behind them. But beneath the surface, the damage is spreading. Phase 3 is the cascade. This is where the real crash unfolds. Forced liquidation, margin calls, panic selling. In 1929, the cascade ran from November 1929 to July 1932, an 89% collapse. In 2008, it lasted 6 months, down 57%. In 2026, it could stretch 12-18 months with a 50-70% drawdown. Here's how the cascade works. Stage 1. Leveraged investors get margin calls. A 20% drop wipes out most of their equity, forcing immediate selling. That selling pushes prices even lower. Stage 2. Institutional investors face redemptions. Mutual funds, hedge funds, pensions must raise cash, so they sell into falling markets. Stage 3. Algorithms accelerate the decline. High-frequency systems detect falling prices, trigger sell programs, and set off stop-loss orders. Circuit breakers halt trading, but when markets reopen, fear intensifies. Stage 4. Liquidity evaporates. When everyone is selling and no one is buying, the market has no bids. Prices don't drift lower, they fall vertically. Stocks gap down 10, 20, 30% because there is no buyer at any level. Liquidity isn't thin, it's gone. Stage 5. Credit markets freeze. When equities collapse and fear spreads, banks stop lending. Companies needing to refinance can't, they default. Banks that lent to them take losses. The cycle accelerates. As the cascade continues, the economy enters recession. Trillions in paper wealth evaporate. Consumers feel poorer and cut spending. Companies lose revenue, lay off workers, and the layoffs create more weakness. This feedback loop is how a market crash turns into a depression. Phase 4 is maximum panic. This is the bottom, the moment fear overtakes logic and people sell regardless of price. In 1929, the panic bottom came in July 1932. The Dow at 41, down 89%, unemployment at 25%, banks failing nationwide. In 2008, the bottom was March 2009, the S&P at 66, down 57%, unemployment at 10%, major banks insolvent. In the next cycle, the bottom could appear in late 2027 or early 2028. The S&P at 6,000 could fall toward 200, unemployment near 10%, multiple bank failures, government intervention on a massive scale. This is the point of maximum fear and maximum opportunity. Phase 5 is the slow recovery. Recovery only begins when the government steps in aggressively. In 1933, the New Deal rebuilt confidence, but stocks didn't reclaim 1929 levels until 1954. In 2008, trillions in stimulus and quantitative easing restored markets faster. New highs came by 2013. In 2026-2027, intervention will return, but the scale will be larger. Rates will drop to zero. Congress will pass multi-trillion-dollar stimulus. Banks will be rescued again. But recovery may be slower than in 2008 because debt levels are unprecedented. With government debt above 120% of GDP and rising, servicing costs consume revenue. The choices become austerity, higher taxes, or inflation. None are easy. Recovery could take 5 to 10 years. Markets may not reclaim 2025 levels until the early 2030s. This is the 5-phase pattern. Initial shock, false recovery, cascade, panic bottom, slow recovery, and within that sequence, 2 groups always emerge: those who lose everything and those who walk away richer than before. Crashes are not just market events, they are transfers of wealth. Violent, predictable, and brutally one-sided. Who gets destroyed? The middle class holding stocks and homes. In 1929, ordinary families who believed they were building wealth watched their portfolios fall nearly 90%. Homes were repossessed when jobs vanished and payments stopped. In 2008, homeowners saw 40 to 50% of equity erased. Many ended up underwater, owing more than their houses were worth. The same outcome hits in 2026. Retirement accounts fall 50 to 70%. A $500,000 nest egg becomes $200,000. Homeowners who bought at today's peak watch values sink by a third or more. Retirees suffer next. Someone entering retirement with $800,000 in savings sees decades of work wiped out in months with no time to recover. Small business owners follow. When spending collapses, cash flow disappears, rent can't be paid, payroll becomes impossible. Thousands of small firms fold, repeating what happened in 2008, but on a wider scale. Their savings, credit, and collateral evaporate. Then come leveraged investors. Anyone who borrowed to buy stocks or property faces margin calls and forced liquidation. Losses don't stop at zero. Debt drags them further underwater. Bankruptcy, destroyed credit, and years of financial ruin follow. Now, who profits? Every major crash produces a group that becomes wealthy precisely because everyone else panics. In 1929, Joseph Kennedy shorted the market and walked away rich. In 2008, John Paulson earned $20 billion betting against subprime debt. Warren Buffett bought elite institutions at crisis prices and multiplied his fortune. The same script plays out in 2026. Cash holders win. Those who exit early, hold cash or short-term treasuries, and wait. When stocks fall 60%, cash gains power. At the bottom, they buy assets at half price. Homes, stocks, entire businesses, while everyone else is forced to sell. Crashes don't create wealth. They reassign it. Always the same way. Warren Buffett entered 2025 sitting on more than $325 billion in cash. When the crash hits, he deploys, running the same playbook he used in 2008, but at far greater scale. A single cycle could add $100 billion to his net worth. Short sellers profit next. They target the weak points of the system: commercial real estate, regional banks, over-leveraged corporations. If you short a bank at $50 and it collapses to $5, the math is simple: $45 per share in profit. Hedge funds preparing those trades now will walk away with billions, just as Paulson and Burry did in 2008. Gold holders profit. In 1929, gold at $20 was revalued to $35 in 1934, a 69% jump. After the 2008 crisis, gold surged from $800 to over $1,900. In 2026, the same dynamic applies. If gold moves from $2,700 to $5,000 as the Fed responds with massive liquidity, holders see extraordinary gains because gold cannot be printed. Distressed debt buyers profit. When companies collapse, their bonds trade at 10 to 30 cents. Funds buy that debt, wait for restructuring, and collect far more. A $100 million purchase can return $300 million. Icahn, Howard Marks, and Oaktree built fortunes this way. They will do it again. Real estate investors with cash profit. When foreclosures surge, properties sell at half of peak value. Investors buy portfolios, rent them, wait for recovery, then exit with enormous gains. Blackstone did this from 2009 to 2012, acquiring tens of thousands of homes. Private equity firms profit. They've raised more than $2 trillion in dry powder. When corporations need cash, private equity buys divisions, assets, entire companies for pennies on the dollar, holds through the rebound, and sells at full value. This is how dynasties form. Crashes don't erase wealth. They transfer it from the leveraged and unprepared to those who positioned early, shorted the weak, and bought the bottom. Margin debt in 1929, subprime mortgages in 2008, corporate, consumer, and government debt in 2026. Different labels, identical structure. Every era convinces itself that this time is immune. In 1929, economists spoke of a permanently high plateau. In 2008, experts insisted housing never declines nationally. In 2026, investors believe the Federal Reserve won't allow a genuine crash. Every bubble repeats the same delusion. None escape it. The cascade mechanics don't change. Forced liquidation triggers more liquidation. Credit freezes, panic selling accelerates. These are not emotional reactions. They are mechanical outcomes once leverage reaches critical mass. The wealth transfer is identical as well. Those holding cash, gold, or short positions exit stronger. Those fully invested or leveraged are erased. This pattern has remained unchanged for a century. What changes is scale. In 1929, U.S. market capitalization was $80 billion. In 2008, $12 trillion. In 2026, it exceeds $50 trillion. Losses of $30 trillion are possible. Speed changes too. The 1929 decline lasted 3 years. The 2008 collapse lasted 6 months. In 2026, with algorithmic trading, instant global communication, and interconnected markets, the crash could unfold in weeks. Interconnection is also different. The 1929 collapse was largely American. The 2008 crisis was global but uneven. In 2026, every major economy is linked. China, Europe, emerging markets, all tied to the same credit system. Stress in one region transmits instantly to all others. There is no refuge. Government capacity to respond is weaker. In 1929, policymakers froze. In 2008, they had room to cut rates and expand fiscal policy. In 2026, rates are already high, debt is already extreme, and the Federal Reserve's balance sheet is already massive. Tools remain, but their effectiveness is eroded. The social consequences could be severe. In 1929, collapse fueled extremism across Europe. In 2008, it deepened polarization. In 2026, with inequality at historic extremes and the middle class fragile, political instability could be far greater. This sets the timeline. Crashes differ in size, but the sequence never changes. This timeline may stretch or compress, but the sequence itself doesn't move. The pattern points to a crash in late 2026 or 2027, and this pattern has already been correct twice. What should you do with that information? This is not financial advice. It's historical pattern recognition, grounded in what worked in 1929 and 2008. First, reduce equity exposure. If you're fully invested, bring it down to 50 or 60%. Hold the remainder in cash or short-term treasuries. You may miss the final gains, but you'll protect capital when the decline begins. Second, hold gold, 5 to 10% of your portfolio, physical or ETF. When the crash hits and the Federal Reserve responds with massive liquidity, gold rises because it cannot be printed. Third, identify the companies you want to own long-term. Build a list now. Strong balance sheets, durable earnings, low debt. When they fall 50%, you'll be ready to buy what others are forced to sell. Fourth, prepare psychologically. The real challenge isn't strategy. It's conviction in the darkest months of the downturn. In March 2009, buying stocks felt insane, yet the people who acted then built generational wealth. Fifth, protect your income. If layoffs become widespread, job security matters. Improve your value, reduce your debts, and build an emergency reserve. If income collapses during the crash, savings keep you alive. Sixth, monitor the indicators. Commercial real estate defaults, regional bank weakness, widening high-yield spreads. When these start moving sharply, the cascade is beginning. The 2026 crash is not guaranteed. It's possible the Federal Reserve manages a soft landing or valuations normalize without a violent break, but the pattern suggests otherwise. Twice before, when valuations stretched, leverage peaked, and confidence became universal, the crash followed. Both times it devastated the unprepared and enriched those who recognized the sequence early. The bubble is inflated. Leverage is extreme. Faith in permanence is total. We're waiting for the trigger. And when it comes, the 5-phase pattern unfolds. Initial shock, false recovery, cascade, panic bottom, slow recovery. Wealth shifts from the leveraged middle class to those positioned correctly. Some lives will break, some fortunes will form. And a decade from now, analysts will pretend nobody could have seen it coming. But you see the pattern now. You can dismiss it and hope this time is different, or you can position for what history says happens next. The pattern is repeating. The crash is approaching. What you do determines which side of the transfer you land on.